right. Hi, everyone. We are live. Welcome to Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm joined, as always, by our senior markets correspondent, Bob Pisani, and today we're going to be answering all of your questions about the latest stock market moves. How are you doing, Bob?
Great, Katie. It is a beautiful day here in the Northeast. We've had like 3 consecutive weeks of amazing weather and no rain at all, which is getting a little worrisome. It's been almost 2 months, but I haven't seen a run this glorious in fall weather in a long time. It's in the 70s here, mid 70s.
Wow. That sounds beautiful. I'm definitely missing that fall weather on the West Coast. But it is November, as you say, Bob, so we have an election coming up. So let's start there this week. What effect is the upcoming election having on the stock market?
Well, simply put, this is a weird year. It's not having a typical pattern. In years when there are presidential elections, and particularly close elections, the market's usually more volatile earlier in the year. Typically, returns are a little lower, even though the market tends to go up after the election. Not this year. I mean, the volatility is up recently, but returns on the S&P have been way above normal, 20%. You know, normal market year, you get 8 to 9% return plus a little dividend on top of that. The 20% is really unusual on top of what happened last year. And the reason this is happening is it's mostly because the economy and earnings remain resilient. And we could talk about that. But one issue for the election, it's not clear how soon the winner will be announced. And the market's reflecting some of that uncertainty. So the VIX, the volatility index, is high. It's at 22. And it's in backwardation. So the front month contracts, the cash contract, November contract, are higher than the contracts farther out. So the curve, the VIX curve, looks like this. It's a little unusual because typically curves look like that. That's called contango, where the shorter the contracts that are near in time are lower priced because you have more certainty with shorter time periods. The farther out, there's more uncertainty. It's reversed because the elections are adding to the uncertainty, and a lot of people feel we're not going to have a winner on that night or maybe for days. We don't know. So that's adding a little uncertainty right now to the market. But otherwise, it's been a quite remarkable year.
Yeah, so you mentioned there's a little bit of uncertainty right now, but we are in the start of a new month. It's November. So where do stocks stand as we enter these final months of the year?
Well, I said that this is really an unusual year. I mean, we're up 20% on the S&P. That is well above the average. And I mentioned returns in election year tend to be a bit subpar. And what's really going on? In the long term, it's the economy that matters. People don't want to believe it. They want to believe that some president is going to change the course of the stock market, and that generally does not happen. In the long run, most of the time, it does not matter whether there's a Republican or a Democrat in terms of the stock market performance. Occasionally, a president will make some difference. When President Trump was around in 2016 to 2020, he cut corporate taxes. And there was a noticeable move because corporations had more profits on their bottom line. That's a rare instance where a president did make a difference. Most of the time, though, it doesn't. Regardless of what happens in an election year, it's really the macroeconomic situation that matters. Another thing that matters is whether or not there was a recession, whether there was a Republican or Democrat. It doesn't matter. So the average total return for a presidential, like a 4-year term, that overlapped with recession was much lower, typically. So the average forward return when there's a recession was 30% in a presidential cycle, and 62% when there wasn't. So that's a macroeconomic question. It's not the president there necessarily. It's what the economy is actually doing. And I know people don't necessarily want to believe that. The bottom line is that the president has much less influence, except in some rare circumstances when there's major legislation. The president has less influence on the stock market than people want to believe.
So, Bob, we had some big tech companies report earnings this week. What did we learn from those earnings?
Well, we're more than 2/3 of the way through earnings seasons, and generically, the numbers have been strong. The third quarter is very typical. So what happens is analyst estimates are generally very bullish and optimistic going in. Then they get a little more realistic because they start getting body language from the companies. The estimates come down a little as the quarter starts. So the estimates for October is when this quarter started, and the estimates came down a little. And then as the numbers come in, they actually report they beat the numbers, and the estimates go back up again. And that's what's happening. So the earnings for the S&P 500 are almost 8%. That's well above the estimates of 6% at the start of October. Almost 80% are beating expectations, and they're beating by a very wide margin, about 7%. That's an unusually large beat. Typically, you beat by 3, 4, 5%. So this is all good. And you mentioned tech. That's being driven by technology. The technology sector is really what drives earnings in the S&P generally. The sector as a whole is expecting earnings up about 17% in the third quarter, and those estimates generally have held up very well. The estimates are essentially technology is seeing mid double digit growth for the last year and estimates into the next year. 14, 15, 16, 17%, quite consistent growth. And you can argue, there's been some issue this quarter about the fourth quarter because some of the guidance has been conservative. So it wasn't the numbers are bad, it's just the guidance are conservative. And investors who always want you to be up and up and up get disappointed. But that's not a terrible number. Being conservative in guidance is not a bad idea. So overall, my opinion is the tech numbers are good. And the most important thing to watch, remember, is the trend. So is the earnings estimates overall going up or are they going down? If they're going up, how fast are they going up? Are they going up faster than they were in the prior quarter? It's called the rate of change, the delta. That really drives things. And by and large, these numbers have held up very well. There's been, I would say, a slight hiccup for the fourth quarter a bit because the guidance has been conservative, but nobody is cutting estimates overall. And for the fourth quarter, they remain pretty strong. So here's the bottom line. S&P 500 earnings estimates have been expected to be up about 10% all year. Right now, it's running 9.5, 9.6. That's within margin of error. It's held up remarkably well. Next year is even stronger. Frankly, remarkably bullish, about 15%. I wouldn't be surprised to see that come down. It's not unusual for estimates to be higher for the following year going into the fourth quarter. So you put together the economic numbers that we've had, which indicate a soft landing, along with the earnings number. And this is why the stock market's at new high. It's a function of the macroeconomic environment and the earnings environment.
So, Bob, our next question is about mortgage rates. Will mortgage rates come down next year?
Don't count on it. And I'll tell you why. This is a more normal range for mortgage rates. What we have seen, and a lot of people have grown up with in the last 10 years, is abnormally low rates. It never was this low before. When I bought my house in 1985, my mortgage rate was 11.5%. And that's what it was throughout most of the 1980s. It only came down into the single digits in the early 1990s. And then it started creeping down. And by the mid 2000s, 20 years ago, that's when you got 6%, 7% mortgage rates where they are now. It's what happened, which really weird, was after the financial crisis. That's when mortgage rates really started dropping because interest rates in general started dropping. 10-year yields started dropping. And eventually we had 3% in 2021. That's weird. Think about this. Do you think a bank's going to be happy to give you money for 30 years at 3%? That's when we got 1% 10-year yields. Do you think it makes sense to give the government your money, let them borrow it from you for 10 years for 1%? That doesn't make a lot of sense to me. That's like a crazy, risky trade. Why would you do that? 1% for 10 years? That doesn't make any sense. That doesn't sound normal. Today, 10-year yields are, 4.5%. That's much closer to historical norms. So people are very unhappy with mortgage rates at 6% or 6.5%, only because they reference it to something that happened 5 or 6 years ago when it was at 3%. But it's the 3% that's weird. So if you want my opinion, the probability that rates are going to be back to 3% is very, very low. The probability is very high that rates are going to stay in this range. So I know that's not good for some people, but if you're saying I'm going to hold off till next year because I think mortgage rates are going to go to 3% from 6.5%. I wouldn't bet on that. I think the probability of that is reasonably low. Now, maybe it'll go from 6.5 to 6, but I'd bet against anything going to 3% again. That is an historical anomaly, I think.
So our next question comes from a listener who said it feels like there's a disconnect between strong job numbers recently, but also seeing a lot of people around them being laid off. So what's actually happening with the job?
Right. So this is part of this is a behavioral economics problem. People think that more people are being laid off than they really are because they might know a few people. If you look at today's employment report, the number of the job creation was unusually low. We were expecting close to 100,000. We got 12,000. There's a very good explanation here. This report is based on a telephone survey, and there was a huge effect of strikes, particularly Boeing, and hurricanes. And this phone survey likely did not capture that. That's the explanation. If you look at the unemployment rate, 4.1%, that's low. Why is there such a difference? Well, because the survey is different. It's the 4.1% unemployment. That's not based on a telephone survey. That's based on actual numbers. So there's these differences here. And overall, job market remains fairly strong. Now, the number of jobs that are available for people to have has been going down, but it was unusually high during 2020, 2021, when everybody was quitting. Now things are going back to a more normal situation. So there are still plenty of jobs out there. The amount of growth in wages is not as great, although you look today, it was 4% wage growth. That's still pretty good. So I would put more emphasis on the actual numbers that are being reported and less on people anecdotally speaking.
All right. And then our last question for today is from a listener who said, why is the rate on my money market fund moving lower?
Because money markets are based upon short-term treasury. What's in a money market? It's basically really short-term government paper, like 3 months would be typical. And that hit a high, earlier this year. It was, 5% or so. And it's been going down for months. The 3-month treasury was 5.2 or something like that in July. And now I think today, 4.5%. It's just been going a little bit lower, but not dramatically. And part of this is because the yield curve is becoming more normal. It used to be short-term rates had a lower yield than higher-term rates, which makes sense. I mean, there's more risk in the longer term in a 10-year than there is in 3 months. So you would get more return. That actually got screwy during COVID. And it's going back to a little more normal situation. So I know a lot of people are in love with these money market funds, and with good reason, because most people are perceiving they are getting a real return, an inflation-adjusted return, and they are, and it's certainly good news. I guess what I'm saying is things are becoming a little more normal. It's more normal to be a 10-year yield in the 4.5% range than it is in the 1% range. It is more normal for a 30-year fixed rate mortgage to be in the 6% range than in the 3% range. And it's more normal for money market funds to have typically lower yields than 10-year, although that's not quite happening yet, but that's sort of where it's going to a certain extent. So the world's getting a little more normal, and that's a good thing. I am very happy to see interest rates a little higher. I know people are complaining about 30-year mortgages, but it's a better environment. If you're a saver, you want a 4.5% yield on your money market. You don't want 0.2%. You don't want a subpar. You don't want that. So I know it's a little painful, but people who are savers care about it a lot more. It's a lot better. And this is a lot better environment for savers now than it was 3 or 4 years ago, for sure. And I'd rather have rates a little higher. I'd rather have 10-year in the 4.5% range than in the 1% range. It's just better for everybody, including savers. And I know about the problems with higher mortgage rates, but people will get used to it. What will happen is there'll be pressure on prices. There already is some evidence that home prices are going to come down. They went up a stupid amount in the last few years. I think that isn't going to continue in the following years. Prices will come down, and you'll see a little bit of relief. And so the market will adjust at some point. I'm reasonably optimistic about that.
All right, well, those are all of our questions for this week. Certainly a lot to watch as we head into the final months of the year. Thank you, as always, Bob, for answering all of our questions.
We'll have a lot to talk about. I think we'll be back in 2 weeks. Hopefully we'll have a winner in the election, and we'll know.
Yep. Yes, we will definitely have a lot to talk about. So enjoy the next couple of weeks, and we'll see you soon.
Thanks, Katie. Thanks, everybody. See you soon.